Hello and welcome to Virtual Investor Conferences. On behalf of OTC Markets, we are very pleased you joined us for the Small Cap Growth Conference. Our next presentation of the day is from Carrier Connect Data Solutions. Please note you may submit questions for the presenter in the box to the left of the slides. You can also view a company's availability for a one-on-one meeting by clicking Book a Meeting in the top toolbar. At this point, I'm very pleased to welcome Mark Binns, Chief Executive Officer of Carrier Connect Data Solutions, which trades on the OTCQB venture market under the symbol CCDSF and on the TSXV under the symbol CCDS. Welcome back, Mark.
Thanks, Greg. Great to be here. I'm excited to present today and let everybody know what Carrier Connect Data Solutions is doing. I know there's going to be some new faces on here, which is amazing, and there's going to be some existing shareholders so we can get an update. This is an exciting company and an exciting time. We're in the data center space. The data center space is very hot, growing very fast, and most importantly, fundamentally, demand exceeds supply. There is more companies looking for places to host their servers and house their servers than there is space, essentially globally. My background, which leads us into this story, is I'm a 4-time public company CEO. I took a company from 2 people, took it public at 3.5 cents, delivered $5 a share for shareholders and reached $1 billion market cap. I retired. I did some consulting in the public company space. And then I decided to start creating some CPCs. And a CPC is a Canadian version of a SPAC, where you actually create a public company, put a bunch of cash in it, and then go look for interesting investment opportunities. And my second CPC was a company called Hopefield Ventures 2. And with Hopefield Ventures 2, I wanted an AI play. And something I could really sink my teeth into for the next sort of 3 to 5 years. I realized, too young to be on the sidelines. Something I could get excited about, an exciting sector that was growing. And my lawyer, who's an amazing lawyer, said, you should look at the data center space. I got friends in the space and they're printing cash and they can't expand fast enough. They're selling space in their data centers, releasing it a year before it's even built. So I went looking for an opportunity in the data center space. First, I did some research. And what that led me to is charts that look like this. What's going on in the data center space? The demand is through the roof, as I said. Revenues are growing globally, Canada, US. And what's really driving it is a big part of it is AI. If you ask AI a query, it takes 10 times as much processing power as typing the same thing into Google. 10 times as much processing power means literally you need 10 times in aggregate, 10 times as many servers. And servers all live in data centers. Every time there's a server used for anything that's in the internet, software, it's sitting in a data center. And even if you're using like Amazon Web Services, virtual servers, they have their own servers they're renting space to you on, and they're in data centers. So that begs the question of, what is a data center? It is the physical location that stores the computing machines that essentially run the internet, run all these AI companies you hear about, everything from tiny, 1-2 person companies, all the way up to, governments, US government, Canadian government, Amazon, Facebook. They're all have servers that live in data centers. It's the physical location where the servers are. You can't see it super well, but this is a rack in the background photo. It's sort of 2 feet wide, about 8 feet high and 4 feet deep. All these lights inside, these are servers. So they get put into racks and they get connected to power first and foremost. So everything gets powered on. They get connected to fiber optics to connect to the internet to do their transactions and processing and whatever they're doing. They get kept cool. So a data center has cooling systems that keeps all the computers cool in the data center, all the servers. That's huge. They all run hot. And then a data center has backup power systems. So if the power goes off from a utility, the infrastructure can't go down. People's servers can't go down because then their companies go offline. You log into QuickBooks and nothing happens because the QuickBooks servers are offline in some data center somewhere. So that can't happen. So there's battery backup systems in data centers. And behind the battery backup systems, they can run for a few hours if the power goes out from the utility. They're diesel generators, or gensets they're called, and they all can run indefinitely. So every company that's putting their servers in a data center is getting space to put their servers in. They're getting power, they're getting cooling, they're getting fiber optic connectivity, and they're getting power guarantees, essentially, and backup power systems. It's the infrastructure that runs the internet. We do not sell servers. And we don't know or care what our customers necessarily are doing with their servers inside the racks. We lease them the space. They run their own company. So we're not worried about whether servers become obsolete or something changes in AI. This is the picks and shovels, bricks and mortar play that is being really driven a lot by the expansion in computing power globally and AI. So that's why I decided to get into the space. Went and said, okay, I got to find a data center, but I need a thesis. Like having one data center is not a particularly exciting story to tell or company to build. So here was the investment thesis. And this was developed early on over a bit of time as I went looking at data centers and talking to them. And I realized there is a ton of very, very good private companies in the data center space running very successful businesses. They're cash flow positive. They have great sticky customers, long-term contracts, everything you'd want in a company. They have the team, salespeople, tech people, everything. The only thing these companies are missing is an exit strategy. So the owners of the private companies that run data centers in the small and mid-size data center space, they're tremendous businesses, but they're not going to take their own data center public. And the large data center companies are $10 billion plus market cap companies. They would buy a portfolio of data centers, which we'll get to in a few minutes, but they're not going to go buy off one-off $10 million companies. And by the way, the vast majority of the data center industry, there's about 300 data centers in Canada. There's probably 10x that in the United States, are medium-sized enterprises. Data centers are not all these giant billion-dollar football field-sized data centers that you hear about. Those are being built. They're being built by like the Amazons and the Oracles of the world. But most of the internet data centers are, what I would call small, medium-sized data center enterprises, a few hundred racks of space. We realize there's an opportunity to buy these companies, to give them an exit strategy, to give them some liquidity if they're seeking the opportunity to retire or get out, and then put these assets into a public company, Carrier Connect, and get them re-rated. So our target is to buy assets at, call it 2.5 times top line revenue, put them into our public company, and realize 10x top line revenue. If you go look at any public data center company, most of them are bigger in the US. They all run at least 10x top line revenue as their market cap to their revenue. So that's an amazing business model. If I can buy stuff at 2.5 times revenue, put it in my public company, build a portfolio. So this is essentially a roll-up strategy where I want to build a whole portfolio of data center companies. That's a 400% return or a 4x return for our shareholders every time I buy a data center. It's also an incredibly efficient use of capital. And everybody wins because the entrepreneurs selling are getting good money for their assets that they built. And we're getting good, solid, cash flowing, again, sticky revenue businesses that don't require any changing or fixing. They're not broken companies. We're just putting them into a public portfolio and getting them properly valued for the liquidity we can bring to these assets. Data centers also run when they're full at about 40% EBITDA. Their customers never go anywhere. IT guys hate the idea of downtime or their servers going down or their customers having problems or anything. So they come, they put their servers in your data center. We're usually signing 1, 3, 5-year contracts with automatic annual price increases, et cetera. But customers don't leave as long as there's no significant problems. We have customers in our data centers that have been around 15 years. We have a data center, we have 2 data centers in Ottawa that I'm going to talk about in a minute. And in 8 years only have ever lost 2 customers, one of which was fired because they weren't paying their bills. Customers stay, incredibly sticky revenue and a very profitable business. So we said, okay, let's go. I want to go buy some data centers and start this company. We went public in February. First data center we bought was in Vancouver, 200 Burrard Street. It is a small metro data center. It's about 50 racks of space, about 1/4 megawatt of power. It was an absolute perfect first data center to buy because I was able to buy it without doing any concurrent financing. I had enough money in my CPC that was my own money, my family's money, close associates, and we were able to get the transaction done. And the public company stood up right away with no dilution. And we have a really, really great cap table that you're going to see when I get there. It's really tight. It's really well controlled. And that's because I didn't have to go raise a whole bunch of money at cheap valuations to get started because we had money of my own from previous business successes in the CPC. Our year end is June 30th. So 2025 is done from a fiscal year. The data center did $500,000, just under $500,000 in revenue. It'll do a bit more this year, but it's basically full. It's profitable. It was a perfect transaction to get started. You'd never take it public on its own, but it was an excellent first asset to put into the portfolio. Then we bought a data center in Perth, Australia. A really cool story because for us, again, we're looking for these private companies or corporate-owned assets that are non-core. And this is exactly what we ran into here. It was a company, a software company in Australia that was doing M&A. They were buying other software companies, and one of their targets just happened to come with a data center. They were not a data center company. They never had any interest in running a data center. As soon as they acquired it, they basically wanted to get it off the portfolio. And we had a connection to the CEO of the company. And we said, listen, we'll help you solve your problem. We'll come and buy it right away from you. We flew down to Australia in July. We did the due diligence in person. We signed an LOI in person. And within a couple of months, we owned the data center in Perth. And I'll tell you some of the stats on it. So it's a 2 megawatt facility. So that's about 8 times as big as the one in Vancouver, 220 racks of space, 3 industrial generators, 3 industrial chillers, full battery backup systems. It is an absolute gorgeous facility. It was once upon a time originally built for Chevron. No money was wasted in the development. It would cost $10 million a megawatt to build a data center today. That's sort of the going rate. So if we wanted to build this data center, it would cost us $20 million. We bought it for $2.5 million. And in fact, we only paid $300,000 cash up front, and the seller gave us all the rest of it on a vendor take back. We had just gone public. We didn't have a lot of cash in the bank yet. But again, they wanted to divest out of this non-core asset. So they said they would finance it for us. For them, it was cleaning up, their balance sheet and their assets. For us, it was an incredible steal because we got a $20 million facility for $2.5 million. If we close this data center today, turn off the lights, turn off the power, and just sell all of the equipment, the generators, the chillers, they're worth over $6 million. It is a profitable company on day one. It has customers in it doing $65,000 a month in revenue on about a $40,000 a month cost base. But the exciting part is it's only 20% full because, again, the company that had it and the company that sold it, they weren't focused on selling any space in it. So it can do $4 million a year in revenue. It can do $1.5 million in EBITDA very easily. And we have multiple customers, large AI installations that are looking at taking all of the rest of the empty space in the facility now. So that's the second asset. Absolutely great asset for us. And then we bought 2 data centers in Ottawa under the brand Pure Colo. One's on March Road in Canada by Terry Matthews and all of the big tech companies. And the other one's on Riverside Drive out by the airport in Ottawa. They're both 2 megawatt facilities, 4 data halls. So each data center is built into sort of 2 different data halls for customers. They have 60 international customers. They're doing about $2.5 million a year in revenue today. On the market cap, remember, at 10x, that's worth $25 million in market cap alone. Their ability to fill up the rest of the space, because they expanded into the second data center about a year ago, is about $6 million a year in revenue. The company's been growing at 40% a year. So it has a $60 million market cap potential very easily. It could be higher with some higher paying AI customers. $40 million build cost. We bought it for $8.5 million. We closed the deal a week and a half ago. And what you're seeing in our stock, and I was going to talk about this at the start, is a re-rating. What is happening right now is the market is waking up to the fact that we now have over 3.7 million in annual recurring revenue. That's worth 37 million in market cap, all dollars Canadian here. We're currently trading at about 24 million market cap, and the stock is going to drift up towards fair market value. And 10x is conservative. There's a public company called Wolf in the data center space. If you follow the space at all, they have about $4.3 billion market cap on 200 million in revenue. They're trading at 22 times or something, over 20 times revenue. There's a lot of multiples like that. 10x is conservative. We closed this deal, as I said. So now we have 4 data centers. We had just gone public in February. Here's the timeline chart. AI helped me build this slide, so it's a little bright. But the first data center in Vancouver was basically acquired by my partner, John Arnett, who's our CTO. Back in 2019, they acquired the data center in 2022. We went public with that data center in February of this year. Then we said, and I wrote this slide in February, by the end of the year, I want to buy 2 more data centers. Well, we ended up with 3. So we ended up now with 4 data centers by the end of 2025. Next year, the intention is to acquire 4 data centers, 1 a quarter minimum. If we get 6, that's better, and be 8 to 10 data centers by the end of next year, which could drive us to a top line revenue of 15 million annual recurring revenue, which is a $150 million market cap company. We're a $25 million market cap or $24 million market cap company today. In 2027, we said, hey, maybe we'll build some data centers. I'm actually thinking we're not going to do that. We're having such great success in finding good assets to buy, add to the portfolio, drive top line revenue very significantly, drive profitability. I don't need to build something and then, take 2 years to do that, then find customers, et cetera, when there's these really great assets I can buy that are already full of customers, and get them for good valuation. So we'll probably just keep expanding in the acquisition plan versus building, but TBD. Plan for all of next year is to acquire existing assets. I talked a little bit about my background. I'm very well connected in the public markets. We have tremendous access to capital. We got a great team around us in the capital markets world. I'll show you an advisor in a second. So we know what we're doing. John Arnett is the CTO. He's the guy who owned the data center in Vancouver. I'd met John before we bought the data center. Very impressed with him as a businessman, executive, and technologist, I guess you might say. John knows everything about data centers. He's definitely the perfect guy for the job. And when we put this together, usually you merge a CPC in a private company and someone leaves. And we said, no, let's do this together next 3 to 5 years, go build a portfolio of data centers. So I'm very fortunate to have John on the team. And we have 2 board members, Mitch Demeter, who helped me build my original company, sits on a lot of different boards and great advisor to us. And Peter Smirniadis, who's a director at Victory Square Technologies, which is an early stage tech incubator and accelerator in Canada. Just really awesome guys to back us. And then Dan Barnholden, who spent his whole career in investment banking, raised over $1 billion for his clients. Him and I were the guys that had lunch one day and said, let's start a CPC. So Dan's been with us there all the way along. He's been the CEO of a company called Luca Mining for about the past year, taking it from somewhere around 30 cents to about $1.40 today. Dan knows what he's doing in capital markets. That's where he spent his entire life. Here's the cap table. I said I was excited about this and I'm proud about this, and I very much am. So we have 24.2 million shares outstanding. Most companies that are reached our level of success in terms of assets and revenue and growth that we're seeing have 80, 90, 100 million shares outstanding. And the reason we don't is I haven't had to go raise any cheap money. We did no concurrent financing on the IPO or the qualifying transaction, as it might be called. We've only raised money as we need it. We've done good deals for data centers with things like vendor takebacks that have no dilution to our shareholders. So we're in great shape on the cap table. We have very significant insider ownership between John and I and the board. We have 4.5 million shares of it ourselves, 14%. We're very incented long term. Also, 4.3 million of those shares that John and I have are actually escrowed out 24 and 36 months. The CPC shares that I had are 24 months. John's data center shares are escrowed 36 months. We're here for the long term to build, a multi-$100 million business at a minimum. There's a bunch more shares escrowed. There's only 9 million shares actually free trading. So we have a really, really great tight capital structure. And when you do that, and you do it right, you don't blow it up with, wasting money on IR that doesn't work, and bringing the wrong people in and, giving everybody shares and doing that sort of stuff, you get a nice controlled stock. We're sitting at about $1 Canadian today. But again, it's still only a $24 million market cap. We're targeting $4 to $5 by the end of next year. If we can, execute, of course, we have to on our acquisition plan that we're setting out on. And so far we've been very successful on. So these are all Canadian numbers. In the US, it's around 75, 77 cents. You can put bids on the US market. The market makers will cross fill from all the volume in the Canadian market. So you don't need to see a seller to get filled. You can put your bid in and, right now it's probably 75, 77, 78 cents US and you'll get filled. These are some projections. If we acquire 4 data centers next year, as I said, we can hit as much as 15 million in annual recurring revenue. This profit number shows about 30% of the top line revenue. Could be higher, could be lower, but Depends on capacity and how quickly we hit capacity in our data centers, and whether we buy ones that are completely full or more like Australia that are profitable but have a ton of room. That number can move around, but you can be sure that data centers have a great profit line connected to them. And then catalysts. So sort of what are we doing? I mean, it's probably pretty obvious. We got to acquire the next couple of data centers. That's what really drives top line revenue in our business. Below that, fill up space we have in data centers. That also is extremely good. Perth is an example. There is no new capital investment required to drive all the revenue that's available in that physical space. All the cooling systems are there. All the racks are there. Everything's in place. We sell it. A customer comes in. It's pure profit. The infrastructure is already there. The lease is already there, et cetera. So we have ability to drive profit very quickly in facilities if there is space available. We have our U.S. listing. I'm hoping we have a lot of U.S. listeners here today. CCDSF, full DTC eligibility, et cetera. We're just starting the U.S. marketing. So if you're here today, congratulations. Your timing's great. You're ahead of the curve. We are going to be doing a lot of this over the next couple of months and into the Q1 of 2026. And I think we're going to see a ton of traction and success from that marketing. And then finally, investor outreach. You can have the best company in the world, but if you don't tell anyone about it as a public company, no one knows and no one can buy your stock. We are going to do a lot of outreach. We're good at outreach. It's something that I'm good at, is getting out and telling the story. So that is going to be a part of going along with, the private side of the business, which is buying data centers, running data centers, and driving cash flow. So we're going to have both, which will be very good for shareholders. I'm going to get to the questions here in a second. There's my contact information. Market Carrier Connect DS is in datasolutions.com. Feel free to reach out anytime. I'm always happy to answer questions. I can send the deck to people if they want it. You can find it on our website as well, which again is carrierconnectds.com. It's in datasolutions.com. And let me run through some questions now. Oh, they're going from what's the initial contract term for customers, and how do you see renewals versus churn? So, we do a lot of 3 or 5 year contracts. And they usually have a built-in accelerator on the pricing. So, a 5% or 10% a year increase that you're sort of automatically locked into. This is the part where I just say, I don't really care what the length of the contract is, because, if the service goes down and people's servers don't run, they'll leave even if they're in a contract. Then you just have a big fight. We have to provide the service, but it's very straightforward to provide the service. Keep power on, keep everything cool, and keep everything running. And there is almost no churn. As I said, customers tend not to leave the data centers they're in. So we have, again, in Ottawa, company's been around 8 years, 60 customers, only 2 have ever left. And one of them was because Pure Colo fired them for not paying their bills. We got customers in Vancouver that have been around 15 years. So very, very sticky structure. All right, thanks. Great question. Given the cap structure, what's the preferred mix of equity, debt, vendor financing for the next acquisition? Great question. So, I like a mix of all three. I like some vendor take back, which puts some debt in. The debt's easily serviceable from cash flows on these assets. It's easily secured against the assets if need be, and it reduces dilution. I'm the largest shareholder of this company. John is my partner. He's equally largest shareholder. We're against dilution unless it makes a lot of sense, right? And sometimes it does make sense because we need to raise money, and we keep raising it at higher prices. Putting $1 into an asset that gives us a $4 return is a good dilution, right? It's a very, very good return. But it makes sense to mix in debt. It makes it, and the debt could be vendor financing debt. But part of it is it's up to the seller. So the seller has a lot of say in this, right? Some of them want cash, right? And I get that. And other ones want equity because they see what we're doing. They want to be part of the bigger picture. And in fact, in some acquisitions, we've seen where different shareholders that are selling decide to take different amounts of their compensation or their payment for the asset in more stock versus and less cash. So sometimes it can even depend on the shareholder in the deal. So there's no firm answer, is sort of the short answer. We need to see what they want and what we can offer. We want to minimize dilution, but we also need to acquire these assets. And we know if we dilute to buy them. We're getting good returns. Looking at 24 to 36 months, what are the key milestones that if you achieved would justify a re-rating? Every time we buy an asset, I think we're going to get re-rated, because when we buy something for $10 and the market value publicly is $40, we're going to have to see a re-rate occur. If I'm out 2 or 3 years looking back, the key milestones, we want to own, at that point, we should be owning like 15 to 20 data centers. We should be seeing 30 to 40% profitability. And there's no reason why that is not a multi-$100-million business. They sound like big numbers, and they are from where we are. We're at the early days, but data center companies, the smaller ones are $10 billion market caps now. The big ones are $100 billion market caps, like Equinix, Digital Realty. Last time I looked, they were both like $80-90 billion. So the data center industry valuations, they go up really quickly because they go up at a 10x times top line revenue. Top line revenues are growing very significantly in the industry because demand essentially exceeds supply. So yeah, if we look back, key milestones, acquiring, a very good size portfolio that turns us into a dividend stock and gives us the opportunity to be acquired by one of the large global data center companies. We're not building it to be acquired, but there's definitely a possibility that someone will want to buy us. Your current stock is 96 cents. Are there insider buying plans? That's an awesome question. Please go look at SETI or look at TMX Money or anywhere else you look at insider buying. I bought this stock probably 30 times since we've gone public. I am a regular, consistent buyer of the stock because I know that sitting where we are and the phase we at, or where we are in the evolution of the business, is an incredible buy opportunity. So John and I are regular buyers of stock. Even though we are largest shareholders, we're still buying the stock publicly. It's all available for everyone to see. So have a look at it online. Someone is asking about, how many LOIs are and what stage are we at after buying Ottawa and Perth? Great question. We're in significant negotiation for 2 different LOIs right now for different Canadian data centers. We also have 2 other data centers that Pure Colo was actually looking at acquiring before we came along that we've picked up discussions on. And there is, 5 more that we're very close to right now. In total, there's literally probably 10 different data centers that we're at various stages of discussion and negotiation. A couple of them are fairly close to LOI stage that we, hope to deliver early in the new year at latest for our shareholders to see what we're doing for the next stage of evolution. How long have we been on the QB? Well, we've been on the QB for probably 3 months now, but we've just started marketing in the US. And is there any intent to uplist on the NASDAQ or the New York Stock Exchange? Yes. I believe next year, depending on timing, right? Timing is important. Stock price needs to be at a certain level. We need to have a certain interest. But this company is the kind of company that I would like to see on the NASDAQ, right? A technology, fast-growing company, heavy in cash flow, heavy in assets, the right kind of sector. So I know the steps, I know the people. I've had multiple people reach out and say, hey, we can help you do uplist. You just don't want to do it too soon because it's expensive and it's time consuming. But as we're ready, we will absolutely be looking to uplist this company to the next market. And I think I'll stop there. So and those are great questions. If there's other ones people want to reach out to me directly, again, marketcarrierconnectds.com. We're at a minute short of our 30 minutes here today. Thank you everybody for coming, for being listening to the story. Hopefully you understand what we're doing and where we're going, and we'd love to have you as shareholders. It's early on. You're going to see a lot of us. We do a lot of these conferences, and I think we're going to have a lot of success over 2026. So thanks everybody who's an existing shareholder for their support, and look forward to welcoming new shareholders to the company. Thanks very much.